If you make money outside of a regular paycheck, freelancing, side hustles, a small business, or even just selling stuff online, the IRS expects you to pay your taxes 4 times a year, not just in April. Skip those payments, and you don't just owe at tax time. You owe more because of a penalty most people don't even know exists. In the next 4 minutes, I'll show you exactly what quarterly estimated taxes are, who has to pay them, when they're due, and how to figure out the right amount without a calculator or an accountant. Here's the deal. When you have a regular W-2 job, your employer takes taxes out of every paycheck before you ever see the money. You don't think about it, but when you're self-employed, nobody's doing that for you. Every dollar that hits your bank account is a dollar you owe taxes on, and the IRS wants its share long before April. That's where quarterly estimated taxes come in. They're prepayments. 4 times a year, you send the IRS a chunk of money based on what you expect to owe for the whole year. Think of it like an installment plan you set up for yourself, except the IRS designed it and skipping it costs you. So, who actually has to pay quarterly? If you expect to owe at least $1,000 in taxes when you file your return, you need to pay quarterly. That covers freelancers, contractors, small business owners, landlords, day traders, and anyone with serious side hustle income. Here are the 4 dates burned into every freelancer's calendar: April 15th, June 15th, September 15th, and January 15th of the following year. Yes, the gap between the first 2 payments is only 2 months. The IRS doesn't split the year evenly, which trips up almost everyone the first time. Now, the big question: how much should you actually pay? The IRS has a rule called safe harbor. Pay either 90% of what you'll actually owe this year, or 100% of what you owed last year, whichever is smaller. Hit either of those numbers across your 4 payments, and you cannot be hit with an underpayment penalty. Period. If your income last year was over $150,000, that 100% becomes 110%. A small premium for high earners. Here's the easiest way to handle this. Take last year's total tax, look at line 24 on your tax return, divide by 4, and send that exact amount every quarter. Done. You're safe. Even if you make double the money this year, the IRS cannot penalize you for it. Paying takes about 2 minutes. Go to irs.gov/payments. Click Direct Pay. Enter your bank info and pick Estimated Tax as the reason. No login, no fees, no account to set up. It pulls the money straight from your checking account, and you get a confirmation number on the spot. Now let's talk about what happens if you skip a payment. The IRS charges interest from the date you should have paid. The rate floats, but it's been running around 8% annually, way more than your savings account is earning. Worse, the penalty compounds quarter by quarter, so missing the first payment is the most expensive mistake you can make. And if you've already missed a payment, don't panic. Here's the move. Pay the missed amount as soon as you can. Yes, you'll owe a small interest charge for the days it was late, but the moment your payment hits the IRS, the meter stops. Then, continue your remaining quarterly payments on schedule. The IRS calculates any final underpayment penalty when you file your annual return, and you can pay it then. It's almost never as bad as people fear. The interest rate is flat, and there is no harsh criminal penalty for being a few months behind on estimated taxes. Now, before we wrap up, let's cover 3 mistakes that cost self-employed people thousands of dollars every single year. Mistake 1. Forgetting about state taxes. Most states run their own quarterly system in parallel with the federal one. If you live in California, New York, or any state with income tax, you owe 2 separate payments per quarter, not 1. Check your state's Department of Revenue for the dates. Mistake 2. Calculating off your gross income instead of your net. Estimated taxes are based on your taxable income, which is the amount left after you subtract your business expenses. If you forget to subtract your deductions, you'll wildly overpay and tie up cash you could be reinvesting into your business. Mistake 3. Missing your first quarter payment and trying to make it up later. The penalty meter runs quarter by quarter, so paying double in the second quarter does not undo a missed first quarter. Now, here's a clever trick almost nobody talks about. If you have a regular W-2 job and a side hustle, you don't actually have to pay quarterly at all. The IRS treats W-2 withholding as if it were paid evenly across the year, no matter when it was actually taken out of your paycheck. So you can simply increase the tax withheld from your day job to cover your side income too. Just fill out a new W-4 form at work, and on line 4C, extra withholding, enter an amount that covers your side income's tax bill. Your employer handles the rest automatically. No quarterly payments, no IRS website, no calendar reminders. The whole problem disappears. So here's your action step. If you've been making side income and you haven't been paying quarterly, go to irs.gov today and pay an estimated tax payment using last year's number divided by 4. The penalty for being late on one quarter is small. The penalty for ignoring all 4 is brutal. Bookmark the 4 dates, set calendar reminders, and you've solved this problem forever. If this saved you a headache, hit subscribe. We break down one small business money question every week. No jargon, no fluff.